Welcome back to the deep dive. Today we are cracking open a metric that seems so simple on the surface, but it has all these hidden layers of complexity. I'm talking about the annual percentage rate, or APR. You wanted us to unpack this one, and for good reason. It's marketed as the great equalizer, right? The one number that lets you compare any loan, any mortgage, any credit card, just instantly.
And that's really the central, unavoidable irony here. I mean, APR is legally mandated. It was designed specifically for consumer protection, for easy comparison. But once you start to really dig into the source material, you find that the calculation is, well, it's highly discretionary. It varies wildly depending on whether you're in the US or the EU. And in many cases, it fundamentally fails to represent the true total cost, especially for a savvy borrower who's really trying to optimize their debt.
Okay, so let's unpack this. Our mission today is to go way beyond the textbook definition. We need to understand not just what APR is, but the multiple, often conflicting ways it gets calculated, and why a legally compliant APR in, say, Texas is mathematically different from one in Portugal. And most critically, where this whole system of standardization just falls apart, leaving you, the consumer, to do the hard math yourself.
Yeah, exactly. So to lay the groundwork, let's start with a core concept that everyone sort of agrees on. APR is the finance charge for a whole year, expressed as an annualized rate. It applies to loans, mortgages, credit cards, and its original intent everywhere was to create a clear standard.
But right out of the gate, we hit a major problem, especially in the United States. It's something that confuses just about every borrower. APR isn't just one thing. There are two main flavors, and understanding the difference is absolutely essential.
Precisely. We have to distinguish between what's called the nominal APR and the effective APR, or EAPR. The nominal APR is the simple one. It's just the simple interest rate for a year. You take the periodic rate, so what you're charged each month or each week, and you just multiply it by the number of periods in a year. It completely ignores compounding.
Okay, so if my credit card says it charges 1.5% interest every month, the nominal APR is just 1.5 times 12, so 18%. But that doesn't account for the fact that each month the interest is calculated on a new higher balance that includes last month's interest.
Exactly. And that's where the effective APR, the EAPR, comes in. Some people call it the effective annual rate, or EER. This is the true mathematically correct interest rate that actually accounts for that compounding effect. And in theory, it should also include any mandatory fees tied to the loan. It's the annual rate you're actually paying.
And that distinction is so crucial because the U.S. system, for disclosure, mainly uses that nominal APR, which is then compounded monthly, but they just label it APR, which is misleading.
Yeah.
And this right here sets the stage for everything else because even the definition of effective, the true cost, gets slippery depending on which fees a lender has to include.
That's the multiplicity problem. We agree that the EAPR should reflect the compound interest plus the fees, but the calculation, it varies wildly. There's just no universal agreement on which fees are non-negotiable costs of borrowing versus just, administrative charges. Things like participation fees, loan origination fees, service charges. Their inclusion is often discretionary or subject to very specific state laws.
So a lender, or even the software they use, has to make an economic choice about what counts as a cost of borrowing. I mean, if a fee is mandatory to get the money, shouldn't that automatically be part of the APR?
Logically, you'd think so. But legally, not always. We can see at least 3 different ways that effective APR gets computed, and they all give you different results precisely because of how they treat those fees. The simplest, and I'd argue the most misleading way, is method 1. You just compound the interest rate for the year and completely ignore all the upfront fees.
So it just pretends the fees don't exist.
Right. It gives you a clean compounding rate, which is useful for comparing interest structures, I guess, but it fails the consumer protection test. It leaves out mandatory charges you have to pay to get the credit.
That seems like a massive underestimation of the cost, especially if you have a big origination fee, like, say, 2% on a mortgage. If it's so misleading, why is it even a permissible way to calculate it, even internally?
Because it simplifies the underlying math. It separates the cost of the capital from the cost of administration. But, to be clear, it's not the standard method for disclosure under TILA, which does require including some fees. And that brings us to method 2, which is a bit better.
Okay, method 2.
Method 2 tries to fix that gap. It takes the origination fees and adds them directly to the balance due. So the whole amount principal plus fees is treated as the new effective principal, and that's what the compound interest is based on. The assumption is the lender financed those fees for you.
So if I borrow $100,000, but there's a $2,000 origination fee, They calculate my interest as if I borrowed $102,000 from day one. That feels like a much more accurate reflection of my actual financial exposure.
It is, and it tends to inflate the APR a bit compared to Method 1, but then there's a third, even more complex approach, Method 3. Some lenders use this one, especially in non-standard financing agreements.
What's Method 3?
Method 3 treats those origination fees as if they're a separate short-term loan that's amortized almost immediately, due in the first payment or two.
Oh.
And then the rest of the unpaid balance is treated as the separate long-term loan.
Wait, so it's like splitting the loan in two. One part to pay the fees right away, and the other for the actual money I borrowed, all hidden in one payment schedule. Why would a lender want to do that?
The incentive is subtle, but it's powerful. If you pay down those big upfront fees almost immediately, the principal balance of the main long-term loan shrinks faster than in Method 2. And this structure can, in some cases, slightly lower the final long-term APR that the lender has to disclose, even though you paid the fees right up front.
So you make a couple of extra large payments at the start to clear out the fees.
Right. And by getting those fees out of the long-term interest calculation basis quickly, the lender can technically quote you a slightly better APR on the long-term note. It's an accounting maneuver, really, designed to optimize the quoted rate.
This just shows how arbitrary the whole process is. Okay, let's get to that shocking example, because this is what really drives home why just including or excluding one single fee can completely break the whole idea of comparing APRs.
This is the aha moment. It's the proof that you can't just look at the APR number. You have to read the fine print on fees. So imagine a really simple short-term loan. $100, you have to pay it back after 1 month, plus 5% interest, and there's a flat $10 administrative fee.
Okay, so after 30 days, I owe them the $100 principal, $5 in interest, and that $10 fee. My total repayment is $115.
Right. Now, let's calculate the effective APR based on two different legal interpretations. Interpretation A, we ignore the $10 fee. We treat it as an excluded administrative cost, so the monthly rate is just 5%. If we compound that monthly rate over 12 periods, so 1.05 to the power of 12, the effective APR comes out to about 79.59%. Let's just call it 80%. That's already high, but it's just the interest compounding.
Okay, 80%. That's the baseline. Now let's factor in that mandatory $10 fee.
Okay, interpretation B. We recognize that a $10 fee on a $100 loan is basically an extra 10% charge for the month. So your total effective monthly charge is now 15%. That's the 5% interest plus the 10% from the fee. Now compound that higher rate for a year. So 1.15 to the power of 12.
That small bump in the monthly rate is going to be catastrophic when you compound it annually.
It is truly staggering. Compounding 15% monthly gives you a factor of 5.35. So the total annual increase is 435%. So for the exact same loan, paid back the exact same way, the calculated effective APR could be quoted as 80%, or 435%.
Wow.
And your ability as a consumer to compare loans just disappears, all because the laws vary on whether that mandatory fee has to be included in the calculation.
So you wanted a great equalizer. Instead, you get calculation anarchy based on legal loopholes.
Right.
The lesson here for you is to always ask for the total cost in dollars, not just the rate.
Exactly. This complexity forces governments to step in and try to mandate standardization. But even that standardization is wildly different depending on where you are.
Let's start with the U.S. regulatory environment. It tries to sort of bridge the gap between that misleading nominal rate and the true cost.
The framework here is the Truth in Lending Act, or TILA. It's implemented by the Consumer Financial Protection Bureau, the CFPB, through something called Regulation Z. In the U.S., the APR figure you have to disclose is this artificially inflated nominal rate. It takes the periodic rate times the number of periods, but TILA requires you to include certain non-interest charges and fees in that calculation.
So it's a regulatory Frankenstein's monster. It's a nominal rate, but it's inflated to account for some fees, making it this hybrid number that's neither the true compound cost nor the simple interest rate.
That's a perfect way to put it, yeah. It requires this detailed, almost arbitrary calculation to figure out exactly which fees have to be covered. And this APR has to be disclosed to you within 3 days of applying for a mortgage. You'll find it on that initial Truth in Lending disclosure.
And if we look at mortgages specifically, the rules get incredibly strict about the accuracy of that hybrid figure. I'm thinking about the Mortgage Disclosure Improvement Act, the MDIA.
Right, the MDIA. It came into effect in 2009, and it introduced a critical rule about the tolerance level for APR disclosure. Regulators realized people were getting surprised at the closing table with slightly different rates. So the rule says if the final APR on your mortgage is off by more than 0.125%,
1/8 of 1%.
Exactly. Just 1/8 of 1% different from the initial disclosure, the lender is required to redisclose.
Why should a borrower care about a number that small? 0.125%.
Because that tiny variance triggers a mandatory 3 business day waiting period before you can close on the loan. It's government saying, you almost misled this consumer, now they get a cooling off period. For you, that 0.125% is a threshold of significant financial inaccuracy. If the actual rate is higher by that tiny margin, the lender has to hit pause, and that could delay your closing by days or even weeks.
And TILA has different rules for different kinds of credit, right?
It does, yes. It splits them into close-ended credit, that's your fixed-term mortgages and auto loans, and open-ended credit, which is your credit cards and lines of credit. The calculations are different for each.
Okay, now let's pivot across the pond, because the EU's goal was radically different. They wanted singular transparency based on mathematical purity.
Yeah, the EU approach is fundamentally philosophical. They wanted to eliminate all the confusion. Their directives basically demanded a unified approach. The goal was to make sure a consumer gets a comprehensible set of information and that every creditor must use the exact same form and formula.
So the idea was, forget nominal rates and confusing hybrids. We're going to force everyone to use the true single economic cost calculation, no matter how complex it is.
That is precisely the objective. The EU mandated a single method based on the internal rate of return, or IRR, methodology. The method is designed to equate the present value of the money the lender gives you with the present value of the money you pay back. The APR is the interest rate that makes those two values exactly equal.
That sounds pretty dense for a consumer disclosure. Can you simplify the principle for us?
Think of it like this. Money today is worth more than money tomorrow. The EU formula is trying to find the single discount rate that perfectly balances the cash flow from the lender to you against the cash flow from you back to the lender. The formula finds that one annual interest rate that makes those two streams of money have the identical value today at the moment you sign the contract.
So it's a true yield calculation. It's like finding the internal rate of return for the entire life of the debt. And the precision they demand is almost absurd.
It really is standardization taken to the nth degree. The EU standard says a year has 365 days, or 366 for a leap year, and an equal month is defined with incredible specificity, exactly 30.41666 days. This makes sure every bank across the continent is using the exact same time assumption for every calculation. It eliminates one source of variability.
And the final APR has to be expressed to at least one decimal place.
Yeah, true.
Uniform standardization.
But this rigor comes with major limitations. The directive only applies to consumer credit agreements of $50,000 and below. And, critically, it excludes all mortgages. The complexity of modeling a 30-year cash flow with variable rates and refinancing was just too much to force into one formula across all member states at first.
But some countries did adopt a similar formula for their mortgages anyway, right?
They did. Places like the Netherlands use a similar cash flow-based formula, and when they do that, it has to account for all the moving parts, the principal, any prepaid fees, and maybe even a residual rest debt if it's an interest-only loan.
And you can't just solve for that APR directly, can you?
No, it's mathematically impossible. Because the APR is embedded in the exponents in the amortization formulas, you have to solve for it iteratively. You basically have to make a guess, see if it balances, and then refine your guess until you get the required precision. It requires sophisticated financial software.
So on one side, you've got the U.S. system, which is standardized but uses a kind of misleading hybrid rate. On the other, the EU system, which uses the mathematically pure rate, but only for small consumer loans. Neither system is perfect.
Not at all. And this all connects to the bigger picture. The whole point of these regulations, whether it's TILA or the EU directives, is to combat one primary tactic lenders have used for centuries. And that's using confusing language to make a loan seem cheaper than it is.
That's why APR was invented, to standardize it so you don't get tricked by terms like rate in advance or monthly periodic rate. So let's take a simple, true, cost and effective annual rate of 10%. What are some confusing ways a lender could quote that same rate?
Oh, there are several. If a loan's true ER is 10%, a lender could confuse you by quoting it as a 0.7974% effective monthly interest rate. That number looks tiny, right? Almost nothing. But compound it for 12 months, and you're at 10%. Or they could quote it as 9.569% annual interest rate compounded monthly. That's just the tiny monthly rate multiplied by 12, ignoring the compounding. or even more obscurely as 9.091% annual rate in advance. This one always sounds the cheapest, but it's just another mathematical trick to get to the same 10% effective cost.
So the whole job of APR is to cut through that jargon so you're comparing apples to apples. But there's a problem here that even standardized APR can't fix. The APR is heavily dependent on the duration of the loan.
This is a critical failing. You simply cannot compare the APR for a 30-year loan directly to the APR for a 20-year loan. It is a factor that matters most.
And that time dependence is all governed by the amortization schedule. The longer the loan, the lower the payment seems.
Right. But the more often that interest has time to accrue and compound before you pay down the principal. As the number of payments, N, gets bigger, the payment size, P, gets smaller, which feels good, but the total interest you pay just skyrockets.
Let's use that classic mortgage example to show the brutal financial gravity here. Say, a simple $100,000 principal loan, no fees, stable interest rate.
Okay. If that $100,000 is mortgaged over 15 years, the total cost you pay, principal and interest, is $193,429.80. The interest you paid is $93,429.80. So 93.4% of the original principal. You nearly double your money.
Now hold the APR constant. Same rate, same lender, but spread it out over 30 years.
Over 30 years, the total cost jumps to $315,925.20. The total interest is now $215,925.20. That's 215.9% of the original principal.
Wait, so the same borrower, same rate, just by picking a longer term, pays more than double the original loan amount in interest alone.
Correct. The APR only tells you the rate of the charge, not the magnitude of the total financial commitment. For a savvy borrower, the calendar is often a much greater danger than a small difference in the rate. APR is meaningless if you aren't comparing loans with identical terms.
This brings up another point, especially for mortgages. The APR calculation assumes you'll keep the loan for the entire term. What happens when that assumption is broken?
This is a major structural failing. Most U.S. mortgages are paid off or refinanced within, say, 7 to 10 years. If you pay off a 30-year mortgage after only 7 years, all those big upfront fees and points that were spread out over 30 years in the APR calculation, they get compressed into a 7-year period.
Which drastically increases the actual effective rate you paid during the time you had the loan.
Absolutely. The 30-year APR significantly understates the effective cost for anyone who moves or refinances. If you move often, a slightly lower interest rate loan with high origination fees will often be way more expensive than a slightly higher rate loan with zero fees, even if the APR is identical on paper.
And before we move on, we have to touch on the money factor, because this is a standard measurement used to intentionally hide the APR in car leasing.
Right. When you lease a car, instead of quoting an APR, they quote a money factor. It's often this deceptively small decimal, like 0.0030. Seems tiny.
How do you translate that to the rate I'm actually paying?
You have to multiply the money factor by 2,400. That's the industry standard. So a money factor of 0.0033, you multiply it by 2,400, and you get 7.2%. That's your actual equivalent APR.
Why 2,400?
The math is a bit complex, but the money factor is basically the average monthly interest divided by the average value of the car. To get it back to an annualized percentage, you have to multiply by 12 for the months and 100 to make it a percent, and it all works out to that 2,400 factor. It's designed to be opaque. It's a way to present the interest so it seems small, forcing you to do unfamiliar math to discover the true rate. It's a perfect example of the financial jargon trap.
Okay, so despite all these regulations, the U.S. APR system still fails in several key areas. Let's start with the most insidious one: the confusion between the nominal rate and the effective rate.
Right. For credit cards, nearly all U.S. products are quoted in nominal APR compounded monthly. The failure is that they use the word annual in APR, but they are not disclosing the true effective annual rate, the ER. The effect of that monthly compounding is hidden, so the bank gets to quote a lower rate than what you actually pay.
So the quoted rate is lying by omission. It's not including the powerful exponential effect of monthly compounding. Let's talk about the financial gravity of this.
We can use the formula to show it. Let's take a common credit card rate, quoted at 12.99% nominal APR. The actual one-year ER is not 12.99%, it's 13.7975%.
That's almost a full percentage point difference. That's not a rounding error. That's like a whole other tier of interest hidden in the math. What about high interest cards?
If a card have a high nominal APR of 29.99% compounded monthly, its actual effective annual rate, the rate you really pay over a year, is 34.48%. That's nearly 5 full percentage points of difference, hidden just by using the nominal quote instead of the ER.
So the rate is quoted at 29.99%, but the true rate is 34.48%. That's a catastrophic hidden cost. Why does the U.S. system stick with disclosing the nominal rate, knowing the year is the truth?
It's largely historical. It's linked to how TILA was first written. Simple annual interest was easier to calculate, and it was accepted as the standard. Changing it now across the entire industry would require a massive legislative overhaul, and there's a significant lobbying against requiring the disclosure of the higher year figure.
And the long-term impact is just devastating. Let's look at that $200,000 loan example.
Okay, a 30-year loan of $200,000. If the lender says the APR is 10.00% nominal, which when compounded monthly is a 10.4767% ER, your monthly payment is $1,755.87.
Now, if that loan had a true flat 10.00% ER, the mathematically true annual cost, what's the payment?
The payment for a true 10.00% ER loan would be $1,691.78. The difference is $64.09 a month. It doesn't sound like much, but you pay that every month for 30 years. Over the life of the loan, that small difference amounts to $23,070.86 in extra interest.
$23,000 extra, just because of the subtle difference in how the rate is quoted and calculated. That's a hidden cost you are absolutely not equipped to calculate on the fly. This brings us to failing number 2, the intentional exclusion of key fees, or what a lot of people call junk fees.
Right. Because APR is a regulatory construct, some fees are deliberately not included in the calculation under TILA. So the APR always understates the total cost of borrowing. These usually fall into 2 categories. First, routine one-time fees paid to third parties, like a real estate attorney. Second, conditional charges, like penalties for late fees or over-limit fees. These are excluded no matter how big they are or how likely you are to be charged.
Lenders say these are just pass-through costs, right? Unrelated to the cost of the capital itself.
That's their argument. They say they're separate transactions, not a cost of the lending itself. They also argue that including things like late fees would require making assumptions about your future behavior, which they say would just create more confusion.
But consumer advocates push back hard on that, pointing out that in many cases, the lender insists you use their specific attorney or vendor. That makes the fee a mandatory cost of doing business.
That is the core of the debate. If the lender controls the vendor, advocates say the fee is part of the total cost and should be included. And this gets even more complicated when you have contingency fees, where the lender gets a hidden kickback from the attorney or appraisal firm for sending business their way.
Which explains why U.S. regulators require lenders to give you an affiliated business disclosure form showing any kickbacks between the lender and these third parties.
Exactly. But even with those forms, the fees themselves are often still excluded from the APR. It means you, the borrower, have to compare the quoted APR plus the affiliated business disclosure form plus the closing cost sheet to understand the real price. It's a 3-step process, not one.
Which brings us to failing number 3. APR isn't a truly comparable standard, even in a highly regulated environment, because of how discretionary the fee inclusion is.
Correct. Regulators just couldn't mandate every single fee be included. So as a consumer, you can calculate the APR yourself, but you still need access to all the costs and assumptions which the lender might withhold.
Let's run through the list of fees and their status in a U.S. mortgage, because this really highlights the confusion.
Okay. There are fees that are generally included. Regulators decided these definitely impact the cost of capital. That's your points, prepaid interest, and origination fees. Then you have the routine costs that are generally not included in the APR. This list is long. Application fees, appraisal costs, credit report costs, the title fee. You have to pay all of them to get the loan, but they don't inflate the disclosed APR.
And then the most problematic category, fees that are only sometimes included.
This is where comparability dies. This list includes attorney fees, document prep fees, and critically, private mortgage insurance, or PMI. PMI is a huge ongoing cost, and whether it's included or not can drastically alter the APR. It's almost impossible to compare lender A to lender B without their itemized fee sheets and a calculator.
And this breakdown is exposed completely in cases of vendor financing, like car sales. The vendor financing problem.
Right. If a car dealer offers you, say, 0% financing, but only if you accept the full MSRP for the car, the true cost of the financing is hidden. The quoted APR understates the true cost because you could have probably negotiated a huge discount on the car if you'd brought your own financing.
So you feel like you got cheap financing, but you really just paid a much higher price for the car itself.
Exactly. The only way to know the true APR in that case would be to find out the lowest cash price the dealer would accept and then use that as the principal. Consumers almost never have that information, so the APR becomes functionally meaningless.
And now we come to the fourth and maybe most controversial failing: the misrepresentation of costs for small-dollar, short-term loans, like payday loans.
The argument here is that APR, because it's an annualized figure, inherently exaggerates the cost of very short-term products. For example, a $25 fee on a $200 loan for 2 weeks, when you annualize it, results in an astronomical APR, sometimes thousands of percent. It's mathematically correct, but it doesn't really represent the actual dollar cost for that 2-week period.
So the tool for transparency becomes misleading, not because it's understated, but because it's dramatically overstated for the short time frame.
That's the perspective from analysts who study these products. They argue you're applying a long-term metric to a short-term product, and it creates a distortion. There's a paper that argues interest rate caps, like the proposed 36% cap, overlook adverse economic effects.
What are those unintended consequences of a strict 36% cap for short-term lenders?
Well, the analysis suggests that when you impose caps that make the product financially unsustainable for lenders, because the administrative cost is fixed, they just stop offering the product. They redirect their capital elsewhere. This leads to a scarcity of loans for the very consumers who need them for emergencies. Demand outstrips supply, and it effectively becomes an implicit prohibition of the product. So while the intent is protection, the outcome might be forcing the most vulnerable borrowers toward unlicensed, unregulated, and maybe more dangerous options. It's a classic regulatory balancing act.
So the very tool designed for protection, when applied too broadly, can unintentionally eliminate the product, potentially harming the people it was meant to help.
It's the paradox of standardization. And a final caveat is that APR also fails to capture the complexity of non-standard mortgages, like variable rates or interest-only periods. You have to make assumptions about the future that may not come true.
And to add to all this, 3 different lenders with the exact same cost information might still calculate 3 slightly different APRs.
Absolutely. The calculations are complex. Most lenders rely on proprietary software, and because there are slightly different methods and rounding rules, small differences in the final APR are inevitable. So you're left with a figure that's supposed to be accurate to 0.125%, but it's built on shifting sand.
We've covered a massive amount of ground today. Our deep dive into APR reveals that what was meant to be a simple standard metric is actually this complex, multifaceted spectrum that rewards cynicism and very detailed reading of the fine print.
The core learning really is that APR is not one number. It varies fundamentally between nominal and effective rates, and its definition is heavily influenced by jurisdiction, where the U.S. uses that misleading hybrid rate, and the EU mandates a mathematically rigorous equation, but only for small loans.
And we saw that critical flaw in the U.S. system. The difference between the quoted nominal APR and the true effective rate can cost you over $23,000 extra on a single mortgage. And those junk fees are often intentionally left out, ensuring the number you see always understates the true cost of borrowing.
And we also established you can't use APR to compare loans of different lengths. The 15-year versus 30-year mortgage example proves the total interest more than doubles at the same rate. Time is often the most critical factor, not the rate. For a savvy borrower, ignoring the calendar is financial malpractice.
So what does this all mean for you, the learner? We'll leave you with one final, provocative thought to consider.
If the calculation of APR is so mathematically demanding that it requires sophisticated software and discretionary assumptions, and if 3 different honest lenders can still reach 3 slightly different APRs with the same information, does this complex standardization truly help the average consumer make a simpler comparison? Or is it just a regulatory hurdle that distracts you from the simpler, more vital task, adding up all the dollar amounts of the fees and the total dollar amount of interest you'll pay? That $23,070 difference shows the profound danger of trusting a percentage over the actual cash flow. What stands out to you?
A question worth chewing on as you look at your next credit agreement. Thank you for providing the sources for this very necessary deep dive. We'll see you next time.